My bad. Apologies, everyone. I've been on mute ever since we started. Apologies to the producer who's probably been flipping all the levers trying to figure out what was wrong. It was totally on my end. Let me begin back to the beginning. Welcome. I'm Flip Pideaux. It's August 11th. It's 8 a.m. It's now just after 8 a.m. and it is inflation day. We've got the monthly CPI number coming at us in just minutes. So here on this special morning edition of the live stream of Polymarket Insiders, we are bringing in our now recurring monthly guest. It's Chris Brunei, better known to you folks on Polymarket and Discord as Exogeny Carl, and increasingly known as the inflation soothsayer. He's been right on the money now 2 months in a row. We're going to see if he can three-peat for us this morning with his read. He does an in-depth analysis monthly on his Substack, which we'll give you the link to in the notes. If you don't have it yet, you should certainly subscribe to that if you are not already. We're going to hear from Chris this morning about what he sees in terms of the overall inflation picture and whether it's going to leap over that 0.6 monthly number to cause the Polymarket contract to resolve as yes this morning. And again, you've got about 27 minutes left to trade, so hopefully we can make you a few bucks here in the final goings. But before we get to all that, Chris, I want to welcome you back. Thank you for joining us again. And how are you in this fine morning?
I can't complain. I'm spending the last couple of weeks in Florida before I'm moving back to Canada. And I'm excited about making this a monthly thing because it looks like we've entered a new structural regime of higher inflation. That's assuming there's not a big drop today. But just in general, I think it's going to be important to track and stay on top of inflation pretty much every month going forward as it becomes a bigger and bigger issue with the macro economy.
Absolutely. Couldn't agree more. And obviously, it's been a couple of surprises this last couple of months, maybe less surprising to those folks who've been reading your analysis or really kind of following the fundamentals here. But it's something that, consumers, policymakers, businesses, employees, employers are starting to pay more and more attention to. So it's obviously not only of interest to those trying to make some money in these markets, but to really any economic participant whatsoever. It's why it's such a timely topic. But before we get to those kind of broader fundamentals here, let's pull up the Polymarket contract if we can. Take a look at the current pricing. This, if I'm not mistaken, has increased even a little just over the last, say, 24 hours. In fact, you're looking at a 24-hour chart there. It's been kind of in the mid 60, 65, 66 most of the last 24 hours. Has now ticked up. Looks like we're at 69 here. So this is suggesting, and again, it's whether the monthly inflation prices from June to July, we're about 2 weeks after the end of the marking period here, will be 6% or more. And the market obviously believes that it's not a shoo-in, but more likely than not to come in at least at that 0.6 number. So before we get totally into the weeds here in terms of what makes up that number and your prediction on it, let's review the last couple of months. Where's this number been and how we should start thinking about whether it's going to be at or above this kind of strike level. What's happened the last couple of months in this market series?
So the last couple of months, it's the main theme that I would say is it's blown past the consensus from professional economists. So the number one place to go to see what economists and banks and bankers are predicting for CPI is Bloomberg. If you have a Bloomberg terminal, there's a month-over-month headline CPI, and they have a probability distribution of those 70 or 80 bankers. And they've been undershooting inflation by big time. Like it's been off the charts for 3 or 4 months in a row now. Off the top of my head, I believe it was 0.5, 0.6, and 0.9. Last month was 0.9, which was the highest it's been in a couple of decades. And 0.9, the thing about 0.9 is if you annualize that over 12 months, it's something like 11%, right? So it's not likely we're going to keep hitting 0.9 every month because that's a little bit of a crazy number. But even if it goes back down to 0.6 or 0.5, which is what we're expecting today, economists today are expecting 0.5. That's the median estimate among professional economists. And if you analyze that, that's still like 6 or 7%, right? And 6 or 7% is it doesn't sound like that much if you're not following the market, like if you're not well acquainted with the markets. But if you've been listening to the Fed, like their target is 2 or 3%, right? So 6% is still pretty crazy, and that's the base case estimate. That's like they're happy to keep it at just 6% annualized.
Right. Yeah, and the consensus the last couple of months has been pretty consistently undershooting. Is that fair to say? Where the real numbers come in?
Yeah. So the way to track this is there's a Citibank or Citigroup. I forget. They have a inflation surprise index, which is an index basically of how different inflation is from expectations. Basically, like the name describes it. And that's at an all-time high right now. In July and June, it hit an all-time high, just simply because bankers have been undershooting inflation for the past few months. And the reason why is because they're very conservative and slow moving. So, like, even if privately, many of them do buy into the story that inflation won't be transitory or inflation is scary, just the fact that they work in these like legacy institutions, right? Their tendency is to be very conservative and slow moving, rather than be like, oh, they can't flip on a switch what their predictions for inflation are. They really have to like ramp it up, and they're just not very nimble in predicting inflation.
It seems weird though. Is no one getting this right? I mean, obviously, I understand when you're talking about kind of the institutional inertia, and you don't want to just throw out the model, on a whim, month to month. But most of the kind of fundamental things driving this inflation, it's not kind of mysterious where it's coming from, right? I mean, you've got record-shattering levels of stimulus being introduced into the economy, and even if that money's not at the door yet, the expectations of it. Not to mention all the supply chain disruptions and other economic disruptions of COVID, not to mention the other government interventions where you've now got businesses competing with the government in increasing wages. The other part of this wage price spiral, businesses competing with government, not just government as a competitor for substitute jobs, but government competing as a supplier of non-jobs. In other words, of a non-working alternative that can pay you better than market rate jobs. So it's this really strange, historically unprecedented inflationary pressure on wages. So again, it's not to say that anyone can look at that and exactly pin where inflation's going to shake out month to month. But again, the sort of overall macro pressures here are not a secret. So are none of these institutions actually getting it right? Is that institutional inertia so significant that even though it's kind of staring everyone in the face, why this might not actually be transitory, and why some of these things, doubling, tripling, quadrupling in price over a couple of months, weird things like used cars and lumber and other building supplies just skyrocketing. I have a hard time understanding why no institutions, obviously filled with relatively smart, well compensated people,
right,
are able to put out a number that, if not is on the nose, at least kind of captures the directionality of this phenomenon. That now it's not just a single month blip. This is, and it's not obviously as transitory as policymakers would have liked us to believe. So why is everyone getting it wrong?
So if you look at the probability distributions of the banker estimates every month, it's not like it's like like inflation's been coming in at the 95th percentile or the 92nd percentile. It's been like straight up, just not a single one of them has got it right. It's been past the 99.9 percentile. And the reason for that, I think, is just from a psychological perspective, they're not willing to take risks. I've said that before, right? Nobody wants to be the outlier who's who is forecasting like such a different forecast from the pack. But yeah, you're right. Like in theory, it shouldn't be impossible to forecast, right? Like there's only so many items that are in the basket, and for each of those items, you can build a pretty reasonable price range. Like everyone knows that the price of lumber went up a few months ago. Everyone knows that the price of used cars plateaued this month. So if you look at, for example, if you look at forecast for this month, like all these different macro groups that are forecasting inflation for this month, they break it down into component by component by component, and a lot of them basically they've been systematically missing almost every component by a couple of percentage points. And when you
And
add
all in the
every
same
component
direction.
together,
They're under.
it adds up to nobody getting it even close to right.
Right.
Yeah.
So let's get into a couple of these components here. And we talked a little bit about used cars. We have a chart here on the used vehicle index. And this has been one of the themes that you've been talking about in your analysis, recent Substack writing about, trying to
Right.
forecast this number a little bit better. So what are we looking at here, this rather dramatic chart?
Okay, so if you've been paying attention to the news, like on my podcasts, I listen to podcasts and like the podcasts talk about used cars. Like it's made its way into the mainstream, like used cars, like it's crazy. Nobody can find a used car. And the chart kind of speaks for itself. Over the past 3 or 4 months, used cars have really almost like, I don't know, gone up by X%. And that has been a substantial driver of inflation. I was hesitant to even say that was a big important driver of inflation because used cars are 1% of the basket, right? And even if they've gone up by 50 or 60%, that's still just 1% of the basket. But I'm finally coming around to admit that has been driving inflation over the past few months. And the theme of this month, so used cars have been a big theme for the past 3 or 4 months, but the theme of this month is that everyone looks to this index. This seems to be the gold standard index that everyone loves to look at to forecast used cars. And it's plateaued. Okay, so you can see right there at the very right tail, it's plateaued or even gone down by a few percent.
So each tick there is a month. So we've got sort of a plateau and then a drop this previous month.
Yeah. And so a lot of people are saying, oh, inflation is going to be low this month because used cars have gone back down. But the thing to know about this chart is, and this isn't exactly a secret, but for some reason, a lot of people are missing it. A lot of people are saying, oh, used cars have stopped shooting up, so that inflation will be pretty low this month. But this is a wholesale price of cars, so the price of cars at auction, okay? And the CPI basket tracks the retail price of cars, which lags the wholesale price of cars by a month or 2 months. And so I'm not sure if you have that tweet from that car expert handy. It doesn't really matter if you do. Yeah, there you go. Perfect. So he seems to have his own proprietary data because he works at he's a car economist. And he works at a car company that sells retail car data. And his analysis is that, so he agrees that retail lags wholesale by a couple months. And he's telling us, like, this is the only glimpse we have into retail, really. He's telling us that the retail prices only started to plateau in late July. So really what I'm expecting, and I have a side bet just on the price of used cars. Someone said hi, Carl. Okay, so he is expecting used cars to go up slightly. That's the end story. But what I'm expecting is, so used cars may have gone up just a little bit this month, where in the past they went up hugely. But I'm expecting housing and energy to more than make up for used cars. So for the past couple months, the narrative has been used cars. But for the next couple months, I think it's pretty obvious that the narrative is going to be energy and the narrative is going to be housing. Energy, first of all, because the price of oil is high. Gas prices are going up. Gas price went up from something like $3 to $3.15 this month alone. So that's going to drive, that's like oil. The price of energy is a big component in the CPI basket, not only because people fill their cars with gas, but also because it kind of filters through to everything, through to transportation, to the cost of apparel, to the cost of shipping, to the cost of food.
Yeah, and a lot of that stuff has a similar, wholesale to retail lag, like you were talking about. And you've got 5-6 months worth of pretty steadily rising wholesale energy costs, and that's going to slowly feed into that retail CPI number, right? And it's not as though that's plateaued either. So this is a story presumably that you'll continue to see into August and September numbers. But certainly in July, you'd think that's another pressure that's still there.
Yeah, energy is for sure one of the biggest pressures in the market right now, and I think you're going to see it in food prices this month. So last month, food prices rose by 0.9. I wouldn't be surprised if they're over 1% this month, just because so many companies, like over the past 2 or 3 months, have said we're rising prices, and now they're actually implementing those price rises. Like in my article, I talk about like I don't know, like every month there's seemingly new big companies that come out and say, oh, like food prices are we're raising food prices, just be warned. And now it seems like they're actually starting to raise them. So I'm pretty confident to say that food is going to go up by more than 1% this month, which is huge, right? That's a 12% annualized or something.
Now, is there any? Let me table that for just a sec, because I want to get into brass tacks here. We got about 12 minutes before the number comes out. As I mentioned before, we were at least when we started the broadcast, 69 cents on this market. Is that still viable in your opinion? It sounds like you think the general thesis here is still holding, that inflation is under expectations are not as hot as the reality. Is that still a good price to clear that 6%? I'm sorry, 0.6% threshold? Can people still buy this?
Yeah, well, that's
levels.
I believe that's what the kids refer to as a bond.
Right.
Well, not a bond. There is like a risk, right? There's considerable risk, but I do think the 40% payoff is worth it.
In fact, now I see we're down to 62 cents. There's not a ton of liquidity here, so that price may move around quite a bit if you're moving into a new position. But at 62, that gives you even a little more comfort.
So the thing about whether or not it's going to be hit the 0.5 that it needs to be under is, so last month it was 0.9, right? And it has to drop from 0.9 all the way down to 0.5, which is a huge drop by itself, which is possible, but it would be, just in terms of looking at the time series, it would be just like it went up a lot last month, and now it has to go up down a lot this month. That's a very simple way to look at it, but at the same time, it is a very slow moving time series, so it doesn't tend to do big, like jagged gyrations like that. So
the best indicator of the next month's number is the previous month's number, if you're even just kind of blind to everything else. So in other words, this is not typically the kind of number where that 0.9 was so huge, so unexpected. Is there any counter argument to say, well, it was so big that all these businesses waiting to put in their price increases, they kind of all did it last month, so maybe there's less inflation. Maybe you got kind of a couple months worth all in the June number. But it sounds like, even if that's sort of a credible counter argument, that's not the way you see it, or that's not the way to look at this series. That it's there's kind of more inertia to this number. It doesn't bop around up and down in a super volatile way like that.
What I would say are the two biggest risks to downside is the number one would be used cars. Like I said, I'm still expecting used cars to go up a little bit, but it's possible they slow down like bigly. It's possible they plateau. And also the PCE, which is an alternate measure of inflation, right?
Right.
That came in this month, and everyone was like, the market was breathing a sigh of relief, because when the PCE came in, it was the first time in a long time that a number for inflation came in under expectations. So
what did that come in at? That was the July number?
Yeah, those it came in only like a few days ago, I think like 3 or 4 or 5 days ago, and it was expected at 0.5, and it came in at 0.4.
Okay.
So that's the biggest risk, I would say. Just like that is a relatively strong signal that inflation could be low again, or it could be low. Since it's low on the PCE, it could also be low in the CPI. But that's like, I've been looking for indicators, and really that's the only indicator that scares me.
Okay, well, let's move a little bit in the minutes we have remaining to a little bit more of the kind of the broader scale macro implications of this. Whether we come in at 0.9 again, an eye-popping number like we had last month, 0.6, 0.5. we're obviously very concerned about those tenths because they impact the resolution of this market. But even if we're at 0.5, let's say we're even at 0.4, that's still a really hot number. I mean, the overall
Right.
moral of the story is that the notion that we've got a little bit of transitory inflation is increasingly evident to not be the case. That we've got a potential inflation problem, and students of economics will understand that runaway inflation, even if we're not talking about kind of South American style hyperinflation, still you get well above that 2 to 3% Fed target, can have significant long-lasting difficulties for the economy. And so, not surprisingly, the White House, Congress, as they've been pushing through this multi-trillion-dollar series of infrastructure and other spending packages, has been trying to very carefully message this, not just the White House itself, but kind of friendly economists, cable news talking heads, and the like. Is that narrative shifting? And what is kind of the messaging that you're hearing now, out of Washington, out of the Beltway, those at least that are pushing the greater spending plans, continued moratoriums on evictions, sure, and continued, benefits that may be further increasing the wage price spiral pressures. Well, how is that narrative changing, if it is at all, in terms of what you're hearing, from those Beltway talking points?
Okay, so for the past few months, it's basically been the blue team versus the red team, right? So every Republican senator has been using inflation as a stick to whack the Democrats with, and every Democrat's been saying, "Oh no, it's not a big problem. Like whatever, it's not. It's transitory. It's nothing. Don't worry about it." And so, even like this morning, the White House came out and said, So a couple hours ago, the White House came out and said they were urging OPEC, the oil producers, to ramp up production. So just in terms of what the White House is saying, yeah, there we go. That signals to me they're worried that the CPI this morning, they know the energy is going to be a big storyline. They know energy is going to be pushing prices up. So that's really a strong signal to me. Like, I think they know the number today is going to be high, and that's them getting ahead of it. That's them getting their narrative out there before the CPI narrative comes.
It kind of gives us a third-party boogeyman to blame it on a little bit here. OPEC is artificially constraining energy production.
They're pointing fingers at OPEC. And the one more thing that I would say in terms of the partisan divide between the Democrats and the Republicans on inflation is so every Republican is like very loud. Like Ted Cruz is very loud on inflation. Every Republican is loud on inflation. But this week, the big shift was that Joe Manchin, who is a Democrat, there we go. Joe Manchin came out against inflation. He is the first prominent Democrat to come out against inflation. And I think this is going to signal a big shift in terms of other Democrats coming forward. He's kind of like he's like kind of a maverick, right? Or like I think now that he's come out and warned about inflation, I think over the next month or 2 or 3 months, as we start ramping up towards the midterm elections, I think you're going to start seeing more Democrat congressmen and senators like yelling about how inflation is dangerous because they want to get reelected, right? And people are seeing food prices go up. People are seeing their cost of living go up, and they're not going to take they'll take it for a couple months maybe, but if it keeps going on for 6 months or a year, I think it's going to be a big wedge issue in the next election.
Yeah. The Manchin is an interesting kind of canary in the coal mine. My guess is you're not going to hear too much noise about this from mainline Democrats, at least until all the ink is dry on all the reconciliation bills and budget plans and everything else that is continuing to fuel at least inflation expectations, which of course themselves can manifest into inflation, even if they weren't ever actually appropriated. So I think this is I think your read is correct. We'll start to hear more and more of this, but I think we'll continue to have a basically broad-based Democratic embargo, at least until all of these congressional adventures are are signed and sealed. Looking at the clock here, it's now 8:26. We've got 4 minutes. So let's see. Let's update the price here. We're still at 62 cents to hit that 0.6 number or greater. Chris, do you have, if you're trying to nail the number, an exact most likely rate you think this comes in at? So two questions. Tell me your best guess in terms of the number, and then your odds that we get kind of a shocking blowout again like we did last month.
So when I wrote my Substack article, I put my estimate at 0.75, which is not a real estimate. It's kind of a cop-out because it can either be 0.7 or it can be 0.8. And I if I had to guess, I would say 0.7. Like that would be the safe guess. That would be still higher than all of Bloomberg, right? Well, so I call it a safe guess, but really it's still higher than every single economist on Bloomberg. So that
none of them have it at 7 or higher or above 7.
I think the highest might be 0.7.
Boy, okay.
Like there's 1 or 2 at 0.7. So that would be the 99.9th percentile for Bloomberg, right?
Mm-hmm.
So that's a blowout kind of in and of itself. I am waiting for the day, and I really want to write an article where I forecast above 1% inflation. That's what I'm waiting for. Mm-hmm. And I think that could be coming in the next month or two. If we see a big number today, especially if we see a big number in shelter, okay? Shelter and housing, I think, is the biggest upside risk because it's something like 30% of the basket. And if you have that chart handy that shows this BLS shelter versus actual rents, the BLS lags actual rents by 6 months or a year, and actual rents lag housing prices. So housing prices, as we all know, have gone up by 20, 30, 40% this year. And that's going to translate into rents, and that's going to translate into higher BLS data. And I think that's coming this month. I think it's coming next month. I think it's coming the month after that. And that's going to be the big narrative. And I think that could push it over 1%. So 1% is really going to be the blowout.
Yeah. Any you got about a minute here. Any users that are viewers that are with us live, if you have a specific prediction and you want credit for it, go ahead and toss it up in the chat. We'll see if any of our viewers nailed the actual number. We're keeping an eye on that BLS page. We'll show it to you when it is released in a mere seconds from now. Going to take one final look at the pricing here. We've ticked up to 63, now back down to 62. So still good money to be made either way if you're on the right side of this. Again, our guest today is forecasting better than 62% chance that we wind up at or above that 6%. Its most likely guess is between 0.7 and 0.8. And let's see where we are here. On my clock, I've got exactly 8:30. So let's go ahead and refresh the page. I'm still seeing the July number, which is to say actually the June number. Chris, let me know if you see it. I may be cached. I've still got 0.9, which is a month old.
I'm still not seeing anything.
Let's take a little Twitter search. Sometimes they might get it a little faster than us.
Yeah, I'm on Twitter.
Here's NBER. Let's see, August 11th. It is.
Oh, no.
Jesus, is it 9%? 0.9 again? No, 0.5%. 0.5. We're under. Is that right, CPIU?
Oh, damn it. CPI for all items rises 0.5.
Yeah. 0.5. So we are under. We are under. We're exactly on the consensus forecast. Interestingly enough, after we spent a little bit of time bad mouthing the economists for always getting it wrong, it looks like they got it. They got it right. Maybe the stop clock theory applies for the month of July. What's your initial reaction here? This is obviously a little bit of a lighter number than you were expecting.
Yeah, well, I have to look at the components, right? It's hard to say. Like everyone rushes to tweet it out right away, but then it's hard to have an opinion about it without looking at. I'm just trying to find. Yeah, I think that's still June on the page, right?
Yeah, no, there's July. Jack, if you could click on the news release there, the headline CPI for all items, we'll take a look at the write up here. Yeah, you see there was 0.5 after last month is 0.9. Food index increased 0.7. Food away from home 0.8. Energy up 1.6. Gasoline up 2.4. So directionally, you're right about that in terms of that being a significant driver of the inflation that we did have. And again, 0.5 is still a very hot number just because it was what economists were
Right.
expecting doesn't mean it's not a worrisome number. So this hot inflation number was in fact driven largely by food and energy. Everything ex food and energy was just 0.3% after increasing 0.9%. So while that's still a hot number, 0.3, and obviously real world consumers can't simply strip out food and energy costs, that represents a little bit of a pullback from, again, ex food and energy in June was 0.9, the same as the headline number. This month, ex food and energy 0.3 versus the headline of 0.5. So it does show that increasingly food and energy were a disproportionate driver of the excess inflation that we had this month. So an interesting story, not too different from kind of the overall thesis. Again, in terms of this market, it all comes down to those tenths, as we were saying, and we slipped in at 0.5, so one notch below what it took for this market to resolve in the affirmative. But anything else you're seeing here as you look through the BLS write-up that's sort of catching your eye in terms of being unexpected?
Well, what I do not see is used cars. I'm trying to find used cars, not new cars.
Let me see. 0.2% used car in July, so smaller than recent months.
That still went up, right?
Yes, up 0.2.
Okay.
Index for used cars. Index for motor vehicle insurance declined, and index for airline fares fell slightly, interestingly enough. I wonder if some of this is due to Delta variant of folks, that were considering, sort of dusting off their vacation plans, have sort of reshelved them a bit as things got a little hairier in the last several weeks.
This is super interesting to see in real time. Usually what happens is I see the number and then I chill for a little bit, but now I'm trying to beat Twitter, right? Twitter comes out with the news usually, and I let them tell the narrative to me almost. But see, they're all rushing to get the narrative out.
Seeing a bit of the real time narrative there. I'm going to take a look at the equity futures as well. See what we're doing there. It looks like we've ticked up a bit on the news. Yeah, we had a little bit of a pop in equities. It'll be interesting to see too what the messaging is here. We talked about that kind of the Beltway narrative here, trying to keep a lid on this in the last couple of months and convince people it's transitory, and that seems to have been thawing a little. I wonder if this will now be an opportunity for them to say, hey, look, it's, again, we keep mentioning 0.5% in a month is not a good number. It's still a very worrisome number. Given that it's the first time in at least 3 months that the number hasn't blown away analysts' expectations, economists' forecast, maybe it gives them a little cover to say, hey, it's not as dire an emergency as the naysayers will have you believe. So, and in terms of the policy impact, does this make it easier for them to ram through remaining spending adventures on capital?
Yeah, well, I think they've set the bar so low. At 0.5 is huge inflation. That's at 6 or 7% per year, right? But they've set the bar so low for themselves that the market's not really going to move on this. I think Democrat lawmakers are going to be empowered to keep pushing more spending legislation through, right? I think this gives them a ton of political capital, because that's what they've been hit with is, you can't spend all this money. Paul Krugman just came out with an article yesterday where he said, let us spend this money because it's going to be fine for inflation. And I think he's going to take a victory lap this afternoon.
You think he's going to take a victory lap? Yeah, I wouldn't be surprised. I mean, the staggering number here too, for, again, anyone who's casting this as a, good news report, is that we're, 5.3? I just had it. No, I lost it. 5.3% for 12 months for not stripping out food and energy, or is it 5.4%? So we're obviously way, way, way above trend, above target, and we referred a little bit earlier to the wage price spirals and the kind of twin pressures that we have going on there, and the way that expectations can become reality when it comes to inflation. This is why it's such an at times intractable problem, is that people see wages going up, then employers say, well, I'm going to have to pay people more, so I got to raise prices. Meanwhile, employees and would-be employees say, cost more money for me to buy things, so I have to demand more money from my would-be employer, especially if the government is paying me the same amount or more to not work at all. So you get this kind of self-reinforcing positive feedback loop. And there is some level at which point that, it's just transitory becomes, no, it's not only sustained, but it's self-sustaining and self-reinforcing. This is a better number than 0.9. This is a better number than 0.6. Don't want to gloss over the fact that is better, directionally better. But we are still uncomfortably into the range where we need to worry about things like that. And so that's why, again, just from a more macro perspective, I'm hoping, against my own natural cynicism, that policymakers don't take the wrong lesson from this and decide that, hey, we can spend whatever we want. We can introduce whatever perverse incentives we want into the economy. And Paul Krugman says we don't have to worry about inflation, so we don't have to worry about inflation. Paul Krugman is obviously wrong more often than he's right. It's just he says so many things that, sort of the Nostradamus effect. He predicts, 20 out of every 3 recessions, and he says everything's good, everything's bad, so you can pick and choose retroactively, and you can claim that he's right. But it's a worrisome report, obviously. But, going back to the Polymarket market here, obviously that's now down to 0. We were expecting this to be more likely than not at $1 now. It's at 0, so apologies to anyone who followed into this trade. It turned out not to work out. Chris, you're still 2 out of 3 here. You still have a winning record when it comes to inflation forecasting on these monthly Polymarket markets. When do you think we would see, not to put the cart before the horse too much here, but the August number that will resolve 4 weeks hence to Polymarket? Do they generally replace this series as soon as one expires?
Yeah, usually it's out within a day or two. The lower the number, the better, because usually I bet the over, right? So in some sense, this is good for next month, because if it was 0.9 again this month, the number to beat next month would be really high. But now, since it's going to be lower expectations, right? The one thing I can't get over is I really find it funny that the biggest increase this month was in fuel, gasoline, energy, commodities. And the White House really did put out a report this morning, like an hour before the numbers were released, and they attacked OPEC.
Right.
You know what I want to get into next is forecasting the gas price market.
Yeah, it'll be an interesting one. It'll be interesting too to see if there's any follow-up on this OPEC. I don't even know what you want to call it, request from the White House, because that obviously was the hottest portion of the print here. But also, we talked before about those things that are kind of leading indicators on the retail inflation number, and again, commodity prices, input prices, basically for businesses, wholesale energy prices. These are the kind of things that flow through in later months to the consumer number. So again, as we're thinking now about what's the August number going to look like, the August number being the one that's released in September, and the sort of forward path of inflation and the policy impact, that's worth keeping in mind too. There's obviously a lot of nuance underneath that headline number of what's the composition of the increase. And again, it was that food and energy,
right.
And the food isn't so much of a leading indicator, but the energy and commodity prices really are, in terms of what's going to be sustained inflationary pressures for businesses in coming months. So worth keeping in mind as you all build out your expectations and models for the next month's market and inflation expectations generally going forward. So I think we're going to basically close it off there, unless Chris, any parting thoughts, other markets that you're looking at today on Polymarket, or lessons you're going to take into your own modeling as you look at this series forecasting out the next month's number.
So I'm writing another Substack article next month, and I would say that is probably going to focus heavily on shelter. I think the fact that shelter didn't show up prominently this month means it's coming next month or the month after that. I'm very, I don't know if I'm bullish or bearish. I think shelter is going to rise. I think that's coming. The biggest feeling I have right now is like I lost a little bit of money on this market, but I'm not too worried about that. I feel bad because other people were following me on this trade and they lost money. But that's it's not gambling unless it hurts when you lose. So
No, that's a good way to look at it. And again, we always want to help people make money and not lose money. But hopefully, if you've been following Chris month by month, you're still net up, and hopefully, we'll win some back of what you might have lost this month in
yep.
subsequent entry in this series. But in the meantime, be sure to follow Chris again on Twitter. He is Exogeny Carl, but goes by the same name in the various Discord servers. And just tell people the URL to access your Substack.
So it's Carl Stack. I have to find it myself. carlstack.substack.com. So if you go to my Twitter, it's my pinned tweet on my Twitter.
Excellent. So strongly encourage everyone to check that out. Subscribe, follow Chris on Twitter, follow us on Twitter. We're at Old Bull TV. If you weren't with us live, feel free to reach out. Our DMs are always open on Twitter. Happy trading to you all. Thanks for joining us at this special live hour, and we will see you next time.